In the early decades of the 19th century, the world was shifting faster than any empire could comfortably manage. The United States was still a young republic, expanding westward and cautiously stepping onto the global stage. Across the Atlantic, Britain stood at the height of its power, commanding the world's most formidable navy and dictating the terms of international trade. And in Asia, China remained the richest consumer market on Earth, self-sufficient, proud, and largely uninterested in anything the West had to sell. Global commerce revolved around the sea. British vessels controlled the major shipping lanes stretching from the Persian Gulf to the South China Sea. Silver flowed toward Asia. Cotton and manufactured goods moved outward, and every nation depended on these maritime arteries to survive. But beneath the elegant facade of global trade lay an imbalance so severe that it threatened the stability of entire empires. The West wanted Chinese tea, silk, and porcelain. China wanted nothing in return except silver. By the 1820s, Britain was bleeding bullion at a pace that alarmed its financiers. The U.S. too felt the effects. American merchants trading with China saw profits narrow as silver grew scarcer and more expensive. For the world's rising capitalist powers, this wasn't just annoying, it was existential. Somewhere in this tightening vice, a new class of merchant capitalists emerged. Families who were neither nobles nor statesmen, yet understood the mechanics of empire better than most politicians. They watched the imbalance, studied the rules, and saw opportunity where governments saw crisis. They recognized that the global system, rigid, hierarchical, and full of loopholes, was ripe for exploitation. Colonial policies made the situation even more volatile. Britain's East India Company operated with its own laws, its own military, and virtually no oversight, turning Indian land and labor into tools of imperial finance. Tariffs, monopolies, and exclusive trading rights distorted markets to the point where private entrepreneurs could, if clever enough, step into the gray zones and build fortunes larger than those of small nations. Intercontinental trade itself was a delicate choreography. Raw goods moved from South Asia to Europe, luxury goods streamed from China to Western ports, and American merchants threaded themselves into the network wherever they could. A small disruption in supply or demand could send shockwaves through New York, London, and Canton alike. By this time, the merchant class had grown powerful but precarious. Profit came with political risk. One wrong shipment, one hostile governor, one shift in imperial policy could destroy an entire enterprise. And the imbalance with China was only deepening, making tempers short and strategies increasingly desperate. Then came a single triggering moment, a policy crackdown, a confiscation of goods, a sudden intervention by a foreign official that turned a long-brewing economic tension into an international crisis. The world's largest empires were now forced to choose between changing their business models or rewriting the rules entirely. And so the question emerged. Faced with a trade crisis this severe, what kind of system would rise next? One built on innovation, or one built on something far more profitable and far more dangerous? In the early 19th century, while the United States was carving its identity as a rising commercial nation, another story was unfolding thousands of miles away, one that would reshape global trade and reveal how a single family could climb from obscurity to international power. Every empire, from London to Washington, had merchants, but this family had something else. An instinct for finding opportunity in the cracks of collapsing systems. They began far from the global centers of wealth. Their hometown was modest, their resources limited, and their social status offered little protection. What they did have was a tradition of trading, generations accustomed to navigating markets where trust mattered more than contracts, and where reputation traveled faster than ships. In a world before telegraphs, that alone was a competitive edge. The society they came from was rigid, often hostile to outsiders, and offered few paths for upward mobility. Economic pressure and political uncertainty pushed them toward a difficult choice: stay and accept stagnation, or leave and gamble everything on a new beginning. They chose the gamble. And like many immigrant families who later shaped American commerce, they arrived in a new land with little more than knowledge, networks, and bold ambition. Their greatest asset was a trading network that stretched across languages, religions, and borders, something American merchants of the same era admired but rarely possessed. They understood credit systems, long-distance finance, and the delicate diplomacy required to operate between empires. This allowed them to see what state governments often missed. Colonial legal structures were full of loopholes waiting to be exploited. They recognized that certain empires enforced trade strictly, except when profit was involved. Licenses could be bought, monopolies could be rented, taxes could be adjusted with the right handshake. And in markets suffering from inefficiency or corruption, a clever outsider could become indispensable. Their first major opportunity appeared when they noticed a gap between two trading powers, one drowning in demand, the other unwilling to supply. A powerful empire needed an intermediary. Local merchants lacked the scale. Officials wanted someone reliable who understood both sides. That was the family's moment. They began with small shipments, modest goods, and cautious partnerships. But the market was chaotic, poorly regulated, deeply political, and riddled with risk. Most traders avoided it. This family embraced it. That single decision set them apart from everyone else. To grow, they executed moves that American Gilded Age tycoons would later perfect, forging alliances with established merchants, offering gifts to key bureaucrats, investing in transport infrastructure, and securing exclusive trading permits. These tactics didn't just boost their profits, they rewired the local economy around their presence. Their relationship with imperial authorities soon shifted. They weren't merely traders, they were problem solvers. When the state needed revenue, they delivered. When officials needed logistics, they stepped in. And once an empire sees you as the person who keeps its money flowing, you're no longer replaceable. Of course, the path wasn't smooth. Rival merchants plotted against them. Laws changed unpredictably. Political unrest threatened trade routes. But through negotiation, financial leverage, and strategic reinvention, they avoided the traps that destroyed others. By the time the dust settled, the family had risen from outsiders to economic power brokers. Their early victories didn't just earn wealth. They built the foundation for a commercial empire that would soon influence decisions in capitals as far away as London, and eventually, Washington. As the 19th century unfolded, a handful of merchant families around the world were beginning to understand something that most governments had not yet grasped. The future didn't belong to the strongest empire, but to whoever controlled the supply chain. While the United States was building its own networks of railroads, ports, and banks, this family, half a world away, was constructing a commercial machine just as sophisticated and, in some ways, far more ruthless. Their rise accelerated when they realized they could no longer simply trade goods. They had to control the path those goods traveled. So they began at the source. They secured raw materials through exclusive contracts with farmers and producers, offering loans that bound entire communities to their company. What started as simple financing quietly evolved into a system where production itself answered to them. Then came logistics. They built warehouses along strategic points of the coast, acquired dockside property, and assembled a fleet of ships large enough to rival regional shipping companies. Each warehouse wasn't just a storage center. It was an anchor in a global network, connecting inland producers to international buyers with almost military precision. In the same period, American business leaders were beginning to champion vertical integration. But this family was already living it. To strengthen the system, they created their own supporting companies, a bank to finance shipments, an insurance firm to protect cargo, a brokerage house to manage contracts, and a transport company to keep everything moving. Every dollar that entered the system stayed inside the system. It was the kind of complete economic loop that future U.S. industrialists, like the railroad barons and oil magnates, would eventually imitate. Their expansion pushed into coastal hubs, treaty ports, and cities with favorable tax regimes. Officials who controlled these ports became their allies, not because they shared ideology, but because the family delivered predictable revenue. They could move goods faster, collect taxes more reliably, and keep commerce flowing even when political winds shifted. That made them invaluable to colonial governors, port commissioners, customs officers, and even foreign bankers. Scale became their greatest weapon. With lower costs, they could undercut rivals. With guaranteed supply, they could dictate market prices. With a fleet of ships, they could redirect trade routes. Competitors didn't stand a chance. Some were bought out, some pushed aside, others quietly destroyed by price wars they couldn't survive. Technological innovation reinforced their dominance. They introduced better storage methods to reduce spoilage, modernized their credit system to speed settlements, and adopted risk management tools far ahead of their time. Their network of agents across Asia gathered intelligence, settled disputes, and ensured every shipment reached the right port at the right moment. Before long, entire regions depended on their operations. Local economies couldn't function without the credit they issued, the warehouses they controlled, or the ships they sent out each week. And like the great American corporations of the Gilded Age, they reinvested every profit back into expansion, growing wider, deeper, and harder to dislodge. By the time their empire reached full scale, it was no longer a trading company. It was an international force, one whose influence stretched beyond borders, beyond governments, and into the very bloodstream of global commerce. The world didn't just buy their goods, it relied on their system to function. By the mid-19th century, the consequences of this family's commercial empire were impossible to ignore. Entire regions, once economically stable, were now showing signs of strain. Local treasuries saw revenue collapse as traditional industries withered. Farmers abandoned food crops for the family's preferred commodities. Ports that had once thrived on diverse trade became dependent on a single foreign-controlled pipeline. What looked like prosperity on paper was in reality a slow-moving economic collapse. Reform-minded officials began sounding the alarm. Scholars wrote treatises warning that a private trading syndicate now wielded more influence than the government itself. Governors and ministers argued that if nothing changed, the nation would lose control over its own markets, labor, and future. Their message was simple. This was no longer trade. It was domination. So the government acted. First, they tightened commercial regulations. Then they increased tariffs, demanded new inspections, and seized a shipment that violated local law. These were modest steps, but they carried a clear message. The era of unchecked foreign power had to end. Diplomatic letters followed, requests for negotiations, warnings, formal protests, a plea for respect of sovereignty. But on the other side of the ocean, in London, Paris, and even in the rapidly growing United States, these actions were interpreted very differently. Western governments didn't see a nation defending itself. They saw a threat to the flow of capital, credit, and commodities their economies increasingly relied on. And once economic interests collide with national power, escalation becomes inevitable. Tension erupted at the ports. Local officials intercepted shipments linked to the family. Merchants resisted. Skirmishes broke out on docks. Warehouses were raided. In one incident that quickly reached foreign newspapers, an entire cargo was destroyed in an attempt to enforce local law. The message was clear: stop the trade, or the country would be consumed by it. The response from the empire defending the family's interests was swift and uncompromising. Warships appeared on the horizon. A formal ultimatum demanded compensation and the reopening of trade. When this was refused, the blockade began. For Western powers, including a young America seeking its own role in global commerce, free trade had become a sacred principle, one they were increasingly willing to enforce at gunpoint. The conflict that followed was short, but devastating. Ports were bombarded. Coastal defenses collapsed. Faced with overwhelming firepower, the weaker nation had no choice but to negotiate. The resulting treaty was not a partnership. It was an imposition. New ports were opened. Taxes were slashed. Foreign merchants were granted immunity from local law. And the family at the center of it all gained a level of access and protection no private enterprise should ever possess. Their rivals, local traders, regional merchants, small shipping houses, were crushed by the new rules. The family's network expanded unchecked, now backed by fleets, treaties, and the full weight of imperial diplomacy. Their influence no longer operated alongside national power. It was national power. By the end of this chapter, their system wasn't merely profitable, it was untouchable. A commercial empire functioning with the force of a military one, reshaping nations while claiming to be nothing more than merchants. By the late 19th century, the family that had once built its fortune in the shadows of empire began rewriting its place in society. Their wealth, accumulated through volatile, politically charged trade, was now vast enough to buy something even more valuable than profit: legitimacy. Across the world, including in an ascendant United States where industrial titans were polishing their reputations through philanthropy, the formula was becoming clear. To secure power for the long term, you had to convert controversial money into respectable influence. Their first step was simple but transformative. They redirected capital away from the high-risk commerce that had sparked wars and diplomatic crises and poured it into projects governments publicly supported. Ports were expanded, rail lines were financed, local banks received injections of capital large enough to reshape regional lending markets. Prime real estate in growing cities, land that would soon host government buildings, universities, and commercial hubs, quietly moved under their ownership. Then came the public works. Inspired by what American magnates like Carnegie and Rockefeller would later perfect, the family funded libraries, hospitals, and research institutions. In cities that depended on foreign trade, these projects weren't just acts of charity. They were statements of permanence, a signal that the family was no longer an outsider profiting from instability, but a foundational pillar of urban development. Their relationship with political elites evolved just as quickly. Governors invited them to private dinners. Legislators requested their advice on commercial policy. Foreign dignitaries visited their mansions. A president, seeking regional stability, publicly praised their contributions to progress. With each handshake and each carefully staged public appearance, their past became less important than their utility to the present. Titles followed: medals, seats on commercial councils, honorary positions in charitable organizations. Newspapers, many of them quietly funded by the family, began referring to them as builders, visionaries, even guardians of prosperity. The same press that once questioned their influence now celebrated their role in modernizing the region. Behind the scenes, they shifted into low-risk, high-prestige industries: consumer goods, shipping firms, domestic banks, investment houses modeled on the financial institutions rising in New York. These were businesses that signaled stability, not controversy. And while their earlier ventures had relied on secrecy, the new empire depended on visibility. Respectability required being seen. Preparing the next generation became a priority. Sons were sent to elite universities in Europe and the United States. Daughters married into political and merchant dynasties. Younger family members joined international banking boards, linking their name to institutions shaping global finance. Within a generation, the family no longer seemed like foreign merchants. They looked like a lineage destined for boardrooms and parliamentary chambers. Over time, the darker chapters of their ascent faded. Records disappeared. Scandals softened into rumors. Textbooks emphasized philanthropy and city building, not exploitation or conflict. And the public, surrounded by schools, libraries, and hospitals bearing their name, embraced the family as part of the national identity. In the end, their transformation was complete. What began as a controversial trading house had become a celebrated pillar of development, an institution woven into the fabric of society. And through this metamorphosis, they secured something no empire, no law, and no rival could take away. A permanent seat inside the legitimate economy, protected by reputation as much as by wealth. By the time the 20th century arrived, the commercial system this family had engineered no longer depended on political winds, local rulers, or even geography. It had become a self-sustaining framework, an architecture of credit, logistics, and international exchange that continued functioning whether empires rose or fell. And in many ways, it foreshadowed the modern global economy that the United States would eventually come to lead. The network they built, linking Asian production, European finance, and American consumption, became a template for the trilateral economic relationships that now define the modern world. Long before the U.S. emerged as the anchor of global trade, this family had already demonstrated how capital could move across oceans, how supply chains could be centralized, and how one private system could coordinate markets that governments struggled to manage. Their model offered a playbook that policymakers quietly borrowed from in the 20th and 21st centuries. When nations crafted trade agreements, when they negotiated market access, or when they deployed financial leverage as a diplomatic tool, they were, knowingly or not, working within principles this early system had proven. That influence flows through commerce, and that power follows the movement of goods. But the legacy was not purely institutional. In countries pulled into the family's orbit, entire societies were reshaped. Populations shifted toward port cities. Traditional industries collapsed while new export-driven sectors emerged. Labor structures changed, sometimes violently. Regional inequalities deepened. Even today, economists studying developmental imbalance in these regions often trace the roots back to the first integration into global commodity chains pioneered by this very network. Meanwhile, modern multinational corporations inherited the architecture the family left behind. International banks mirrored their credit systems. Global shipping companies adopted the same multi-port logistics. Investment houses used similar risk models. The idea that a private entity could operate above national boundaries, answering not to any single government, but to its own internal logic, was no longer radical. It was the operating standard of global capitalism. And this raises the larger dynamic, the fusion of trade and geopolitical power. From colonial treaties to modern sanctions, from naval blockades to supply chain diplomacy, the principle has remained intact. Wealth shapes policy. Access shapes influence. And nations, whether the United States, Britain, or the EU, continue to employ strategies remarkably similar to the ones the family once used to secure their dominance. Their impact also permeates global finance. reserve currencies, international debt cycles, capital flows that can destabilize entire nations. These mechanisms didn't originate from them, but their system helped accelerate the shift toward a world where financial dependency crosses borders more easily than armies ever could. Today, historians and economists see the family as a case study in concentrated economic power. University courses in American economic diplomacy reference their role in early globalization. Research into financial history uses their network as an example of pre-modern multinational behavior. And comparisons to present-day giants, big tech, global banks, and supply chain conglomerates are unavoidable. The tools differ, but the strategy is the same. Control the infrastructure of exchange, and you control the world built on top of it. In the end, their story stands as one of the clearest examples of how commercial influence can outlast empires, transcend borders, and shape the trajectory of nations far beyond the era in which it was born.